One of my favorite guests, Samit Vartak, founding partner and CIO at SageOne Investment Managers in our studios. Samit, so good having you. Thanks for taking the time out.
Absolutely my pleasure, and great to see. I mean, it's such an impressive studio, and all the best, for the next journey.
Thank you so much. It seems like we don't need to wish market participants any luck because the market seems to be on a bit of a euphoric roll, really.
Yeah, I mean, that's how markets work. I mean, once it starts any journey, I think on the way up, there is nothing to stop it. And I think people started worrying about the markets maybe 6 months before this. And now, after the state election, I think markets are getting more confidence, than what they had 6 months back, right? So, unfortunately, right now, I think the problem is that there is no one who is skeptic of the market. All the skeptics have been converted to being bullish, and I think that's the worry part of the market. I think 6 months back there were so many worries. Federal Reserve taking up the interest rates, and no one knew how far it's going to go. There were question marks, on inflation. There were question marks on, a lot of economic issues. But now, Federal Reserve has peaked. I mean, the question is how much they're going to cut. There are no, worries on the elections, the Lok Sabha elections, and hence, the FIIs also. I mean, in the last month or two, the number of inquiries that even we have received from FIIs is I think, completely different than what I've seen in the last 2 or 3 years.
Wow.
So.
Why do you say that? I mean, as in the nature of the inquiries, the quantum of the inquiries, or the number, or the nature of people who are coming in?
Yeah, the nature of people who are coming in.
Can you elaborate a bit?
There are a lot of sovereign wealth funds, larger funds, who are managing like multi-billion dollars. Those kind of funds are now showing up. I think before this, I would probably see smaller family offices, who are, more active, and they're looking for niche investments. But these are massive investors who now are definitely looking at India. I think before they must have thought that, we have until May or, June until the election, and let's prepare for it. But suddenly, there was the state elections, which has probably, pushed these investors now that probably they need to prepone, whatever decision making they had to do. And that's where, everyone is lining up. I mean, people are visiting India, people are doing, phone calls. I think that's very different than what I've seen in the past few years.
That's an important point. By the way, abracadabra, there is a water glass for you there. but the limited point, Samit, that I would love to understand from you as well. So if you were, I don't know if you were, I know you rely a lot on data, and I want to get to the data part as well, but just a qualitative point first. If you were an investor who was waiting to understand what could happen to the elections, because like it or not, it's a big event.
Right.
Does this state election verdict tempt you, therefore, that let me now not wait for 2024, which it seems to be a case of political continuity, and even though the valuations might optically appear a bit stretched, let me go in and deploy the money that I want to deploy into India because I have predictability for the next 5 years.
Right. I mean, see, for me personally, of course, the more worries, the better it is, to come into the market. And I think that's the kind of market we were in, in the past few months, even in the May, June, July period. There are a lot of worries. But I think for foreigners who probably do not want to take that event risk, this is a time maybe where even that 1-2% probability, I think, has shrunk. So. And again, I always talk about, scarcity premium, right? I mean, we do have scarcity. If you look at the global options today, there is definitely scarcity of growth. There are maybe the pessimistic scenario of US going into recession or Europe going into large recession probably isn't going to play out, right? But still, coming back to growth is difficult. And we have seen the kind of issues with which China is facing, and the kind of issues even smaller emerging markets are facing. I mean, you can see what's happening in Vietnam, or you can see what's happening in Bangladesh. So the competing markets that India had are facing a lot of macro issues, right? So India is definitely standing out, and I think post-COVID, people did experience the resilience of the Indian markets as well as the Indian economy. It's not just the Indian markets, but the Indian economy. And in terms of consumer leverage, or in terms of government leverage, in terms of the way we control inflation, the way RBI handled the interest rates, and now the differential between sort of the AAA economy's interest rates and us is very little, right? So a lot of those factors, because it does play into the cost of funding for the government, cost of funding for even the corporates, right? And if we are thinking of becoming the next manufacturing hub, that definitely makes a difference. So I think for foreigners, since they are under allocated, I mean their allocation to India is probably the lowest in the recent past, it makes sense to start investing. Maybe they'll not come in at once, but I think the initial installment is something that definitely is due.
Interesting. Now, Samit Vartak relies a lot on data. If you read any of his notes in the past, it brings out data points. So at a point of time when the street might have been very bearish on the broader end of the spectrum, Samit's note laid out why there was no reason to be pessimistic. I'm interested in knowing, because I haven't seen a published note in the recent past, but I'm interested in knowing behind the quantum of work that Samit puts in behind some of those notes. The note may not have been out if there was one to be intended to be.
Right.
What are data points that you are measuring right now, telling you about what could happen in the near term?
Sure. So in September, because during September there are a lot of notes out, pushing investors to probably get out of the small cap, mid cap.
Right.
There are a lot of worries. At that time, I made it a point that at least sent out a note to my set of investors, because what I was seeing was very different. There were and few of the things that I think if you look at the last few years, the net profit growth has been pretty subpar. Maybe 8 to 9% per year in the last 8-9 years, especially during the Modi era. But I think what's different is the growth in the cash flow from operations. That's been at a CAGR of 15 to 16%, right? So, and that's the CAGR for the market. So the cash flow from operations growth and the market returns are pretty similar. So it's not that the markets have run up, because people tend to focus a lot on the P&L profits. I think that's sometimes a mistake, and one needs to see what's happening on the balance sheet too, right? Because the net of what's happening in the P&L and balance sheet is reflected in the cash flow, and that's what we are seeing. At the same time, if you see this year, there was a note from Avendus Spark which showed that the number of approvals of bank loans has shot up to all-time highs, meaning that 3.5 lakh crores of approvals happened during this year, which is 80% higher than the same period last year, right? That means even corporates now are definitely, because this is a precursor to the actual capex which is coming up, right? And that also gives you a lot of confidence that the corporates are finally, until now it's been the government who has been going for capex, but even the corporates are now going for capex. And I mean, again, this is a time when, if you see the same, the debt to equity ratio is still towards the lower end. The median is still close to 0.2 times. And a lot of small caps are debt free, which you have never seen. The return on equity, I'm talking of cash flow, but even the return on equity for small cap is at 16%, which used to be in the 12 to 13% range.
And usually this is a trend, right? I mean, small caps don't hit 25% in year 2.
Correct.
They start off single digits, then move on to 25 or whatever number it might be.
Exactly. So, I mean, you have had a pretty subpar last 8-9 years, right? And there were a lot of improvements which the economy has seen, the cleanup of the banking system, the corporate tax cuts, have been cut. And just look at the corporate India, its balance sheet, its cash flow has improved significantly. So if there was no stock market today, and if you just had to look at the economy, you would see no frothiness in it. There is no frothiness, right? But unfortunately, investors tend to focus a lot on just the valuation as a parameter. Whenever there is frothiness in the economy, you would see it. Everyone going for capex like anything, the leverage is at the highest level, the working capital cycle increasing rather than shrinking. Right? Because the credit terms loosen during such times. And today what you are seeing is exactly opposite of what that frothiness would indicate. And I think that gives you more confidence. So there are a lot of factors which are in favor of India doing well, except the flows and because of which the valuations a bit. But valuations, are expensive. But I think valuation risk is something which probably is worth taking. Staying out of this market, and what if you go into a next 5 years of a great growth phase? What India promises, if it really delivers, do you want to sit out of this market? That's the big question. And I don't think it's not worth taking that risk. Let the economy reach a frothiness level. Economy, I'm not saying stock market. Maybe at that point, if the fundamentals indicate that this is the peak, peak margins, peak working capital cycle, loosening of credit terms, that's the time when I think one should consider sitting out of the market.
Yeah. And it's interesting. I was just trying to remember a note that was written maybe sometime in 2017, if I'm not wrong, by the co-founder and chief investment strategist at GMO, wherein he said, "Brace yourself for a near possible melt-up." And Samit, is that the point you're making, that staying invested might help? Because the statistic that is thrown out very often is that look at the trailing 12-month earnings of the small cap index and the P multiple. It's trading at 30 times, therefore it's expensive, therefore time to book out. You are saying that it not necessarily be the case.
It's not necessarily, because at least in terms, we haven't had like last 2, 3, 4 years of great earnings growth, or we haven't had. Even if you look at last 5 years returns or last 2-year returns, they aren't, out of the world. So they are in that 20% kind of a range. Even at this point to point, because we are at the peak of the market. If you look at any real peak in the market, whether it was like 2008 or 2017, you would see last 2-year returns were crazy. They were in 30s or in 50s kind of level, which we aren't seeing today.
Okay, I'm going to talk about a specific pocket with you after the break, but before we take that break, I obviously want to understand what is it that you find favor with currently, Samit? I mean, you've traditionally been a bull in chemicals and then you logged out. Then you've been bullish on the construction materials, real estate ancillaries. I reckon you would still be constructive there, so that might continue, and the real estate cycle at large. What else is new in the last 12 months? What has come afresh in the portfolios? What do you like the most? So
I think what has come afresh is a lot of financials have come into the portfolio, which we really didn't have much. Many of them don't really meet the kind of growth rate that we're looking for. Doubling of earnings in 3 to 4 years. That's something which is missing in financials, a lot of financials. But a lot of them are coming up now, at least in the screen. So we have added a lot of financials. They may not be banks, but there are power finance companies or home finance companies, even microfinance kind of companies, because there is a lot of growth which is coming in. We are still very positive on the capital goods, anything which is building of India, whether it's through private capex or whether it's through government capex. I remain very, very positive. So that's where, of course, you need to find pockets which are comfortable in terms of valuation, because that's very important. The kind of money which is flowing into the mutual funds, it's just running up a lot of valuations, in some of the really favored sectors or herd. So there is a lot of herd mentality which is happening.
Sure.
Everyone is running after the same small pockets. But if you look beyond those pockets, there is value still. I was just looking at BSE 500, right? BSE 500, even if you just split it up into PSU and the non-PSUs, the PSU pocket is up 80% in the last, say, 1.5 years. And if you break up that 80%, majority of that is just valuation re-rating. The earnings growth is subpar even compared to the non-PSU pocket, but it's just 15% kind of a growth, and the remainder is just valuation re-rating that is happening. So sometimes one needs to be careful, and I think what's also happening in the market today is everyone is running after the order book and the growth, but one also needs to be careful what is the return on equity that can be made on that order book. If that is going to be less than 15%, I don't think it's worth the growth. If you do not deliver even return on incremental, order book of 13-14%, I think you're destroying value for the market. The company should not be adding market value. It should be destroying market value, because I can just have a simple business of investing in fixed deposits, right? The more money I pour in, the more profits I will generate.
But it's not.
But then, it's destroying value for the investor, because my expected return is going to be 15%, not 13-14%. So if you are just deploying at that rate, actually the market cap should go down, not up. But in this market, the market cap just keeps on multiplying, even if the return on investment of lot of those. And there are also businesses within PSUs which have much higher return on equity. So if one focuses on that, and if there's a big order book which is building up there, it definitely makes sense.
Which is where last question, which is where the financiers come in as well. I heard you say that there are power financiers, there are one or two there, and everybody's playing power, you're playing it through the financiers.
Exactly. Because the profitability and growth, it's much more predictable there. And if you see the balance sheet, it's improving. Their market opportunity also is increasing, as well as the balance sheet has been increasing. The provisioning that they did over the last couple of years or 2 or 3 years, actually they're getting right backs.
Wow.
So you would see that the overall ecosystem in the power is improving, which is reflecting in the power financiers.
Okay. Well, you know from the bulk deal data that has come out of the last 2 months or 3 months as well, that Samit Vartak is not shying away from betting on mid caps and small caps.